Stephen Schwartz. I'm a professor of law and business at Duke University. It's an honor to be here. Our topic is regulating global stablecoins and other cryptocurrencies. And we have distinguished panelists, two of which are yet to show up, but that makes them maybe a little bit less distinguished, but we'll see. In any event, I'm going to give an overview of stablecoins and other cryptocurrencies, and then I'll introduce the various panelists who will go further.
Given the noise outside,
yeah, maybe close the door.
The fact that we don't have any microphones. I mean, I see a camera there. Are they recording this?
I think they're recording it. It's the red light on, which may or may not mean anything. Okay. So governments and the private sector are attempting to design so-called retail digital currencies. And these are consumer-friendly monetary currencies that are evidenced electronically and not in physically tangible form. Now, being intangible, digital currencies need another way to be identified. And the most typical way is to evidence the currency through cryptography or mathematically secure codes. And the most common is the codes that are recorded on so-called blockchains. Digital currencies are therefore often called cryptocurrencies because of their cryptography. There are two types of digital currencies that are likely to become widely used in the near future. One type, central bank digital currencies, or CBDC. Okay, we have all of our panelists, I think, yeah. So I'm giving an overview right now of digital currencies, of cryptocurrencies, and the basic point is that digital currencies, cryptocurrencies, the terms are synonymous. The idea is that digital currencies are electronically evidenced, and therefore you need some sort of secret coding to protect them. Now, there are two types of digital currencies or cryptocurrencies that I think are likely to become widely used in the near future. One type is so-called central bank digital currencies, often abbreviated CBDC. And these are cryptocurrencies, and in fact, in the Q&A, I will explain they don't necessarily even need to be cryptocurrencies, but they can be cryptocurrencies, and they're sponsored by government central banks, like the Federal Reserve, like the European Central Bank. The other type of digital currency likely to become widely used are stablecoins. And these represent non-government issued digital currencies that are backed by, that is, exchangeable for assets, sometimes referred to as reference assets. And these assets would ideally be something of clear value, such as a government fiat currency, for example, a US dollar. That would be a typical, or one form of an underlying reference asset. Now, the many institutions, the Bank for International Settlements, often called BIS, which essentially is a bank for central banks. So the BIS, the Federal Reserve, many other prominent government institutions have argued that it's important to provide a robust legal framework for regulating retail digital currencies. For example, if these currencies are used for making cross-border payments, then requiring compliance with a multitude of laws in the different jurisdictions where they're used would be exceptionally expensive, both legally expensive and operationally expensive. Furthermore, the interaction of conflicting legal frameworks could create uncertainty about the enforceability of contractual obligations. Now, for a central bank digital currency, CBDC, I think these costs should be relatively low. Government central banks have long worked together to try to harmonize national banking regulations. And they do this in order to try to minimize cross-border costs. The most notable example are the Basel Capital Accords. And these set out international standards for supervision of financial institutions. They focus primarily on requiring banks to maintain sufficient equity to support their operations and to cover losses. And in the same way, central banks should be expected to work together to try to harmonize CBDC regulation. However, for so-called global stablecoins, these are stablecoins that become widely used internationally. These costs are likely to be very high. Being non-government issued rather than central bank issued, global stablecoins could become subject to numerous laws, and they could become supervised by a multiplicity of government agencies. And some of the government agencies may lack the precedent and or tradition of working together domestically, much less internationally. As an example, let's assume there's international coordination for the United States. At least 5 federal entities would need to be involved: the Federal Reserve, the Office of the Comptroller of the Currency, or OCC, the Securities and Exchange Commission, the Commodity Futures Trading Commission, or CFTC, and the Financial Crimes Enforcement Network. Plus, they would have to work together with their corresponding international organizations, and this could be compounded in the United States because individual states are now also beginning to consider regulating cryptocurrencies, especially stablecoins. So stablecoin regulation might require also some form of government backstop. And the key to a stablecoin, as I mentioned, is that the issuer of the stablecoin has an obligation to redeem the stablecoin when someone, a holder, presents it for the underlying reference asset. So if I own a stablecoin and the underlying reference asset is a US dollar, I go to the issuer and I say, here's my stablecoin, immediately pay me a US dollar for each stablecoin, or whatever the conversion rate is. The failure of the issuer to redeem the stablecoin for the underlying reference asset on a timely basis could create a really failure of confidence, sort of a run, very similar to a bank run, where you go to a bank, you know, the old thing, you go to a bank and the bank can't pay out all of its depositors and everything melts down. This could happen too with a stablecoin. And if that global stablecoin is widely used, this could impact the real economy and have a systemic economic effect. Now, all this calls into question how to achieve international regulatory coordination. I mentioned that under the Basel Capital Accords, you have agreements among central banks and other regulatory agencies, and that's possible. But in terms of legislation, there are 2 approaches. One approach could be an international treaty. Another approach could be an international model law. And let me explain the difference. A treaty, sometimes called a convention, is an agreement among nations. And it's very typical for a treaty not to come into effect until some minimum number of nations ratify or confirm the treaty. And a treaty is regarded as highly formal. A treaty can sometimes take months, if not years, to get the requisite number of nations to ratify it. In contrast, a model law is simply a model of what a domestic or national law on a subject would look like. For those familiar with American law, the Uniform Commercial Code, or UCC, is probably the most well-known example of a model law. It's promulgated and put to the different states, and each state is basically asked to enact it in the form prescribed, or at least very close to the form prescribed. And a model law is very flexible. It comes into effect for any nation that enacts it as the national law, regardless of whether any other nation has enacted it. And it also provides a good pattern for set the norms of what the regulation should look like. So I would argue that at least for cryptocurrencies that are new and for which we need quick regulation, a model law approach may be preferable to a treaty approach, at least in the short run. The final thing I'd like to point out as an overview, and this is to provide perspective, I've discussed central bank digital currency, CBDC, stablecoins, which are basically redeemable for the underlying asset. But another type of cryptocurrency would be like a stablecoin that is non-government issued, but without the redemption obligation. And the best example, most well-known example of this would be Bitcoin. And Bitcoin is not redeemable on any contractual basis. Now, what that means is that Bitcoins or other such non-government issued, non-stable coins, cryptocurrencies, would have a fluctuating value. And at least on a retail basis, that makes it difficult for consumers to use. A successful retail currency should have stable value. So if anything, if we're talking about regulation of Bitcoin or other such non-stable coins that are non-government issued, I think the regulation should be to protect the consumer against the fluctuation. So I'm going to sort of introduce the speakers now. And we have 4 really wonderful speakers. We have Andrea Oviedo from Bolivia, and she is an financial advisor to the Andean Community and Pacific Alliance, director at Latin America Invest. We have Richard Berner, who is clinical professor of finance, co-director of the NYU Volatility and Risk Institute, and also a professor at NYU Stern School of Business. We have Tom Noone of the Federal Reserve, who is Assistant General Counsel of the Federal Reserve Bank of New York. We have Douglas Arner, who is the Kerry Holdings Professor in Law at the University of Hong Kong. And we have, I assume, Dasong Yuan, who is a professor at Beijing Normal University Law School. So we're going to start. Let me ask Richard Berner or Dick Berner to start. He'll discuss principles for regulation and governance of the crypto industry.
Okay, Stephen, thanks so much for inviting me to this conference and to organizing this session. I'm going to discuss 2 related topics today. The first deals with crypto regulations, which Professor Schwarcz has already alluded to, and the second addresses crypto governance, that is for the industry. Now, I wrote 2 briefs on these topics for the Bretton Woods Committee for their Future of Finance initiative. And the point of the briefs was and is to articulate principles for regulation and for governance that can form the basis for both and allow whatever benefits these innovations might confer on financial activity to become apparent. Now, putting my cards on the table, I am a crypto skeptic. 15 years have passed and I've yet to see the benefits from it. In that sense, I'm with Professor Hillary Allen at American University in Washington, and maybe Todd Baker as well. And I am very much for walling off crypto from the banking system as the regulator's January guidance prescribes, as long as it remains unregulated and ungoverned. But I am not in the let it burn camp, as some are. I believe in innovation if it creates net benefits and is well governed. And if this innovation is going to be around, we had better make sure that it does no harm. For regulation, I think three principles are relevant. First, innovation that is responsible. Second, same risk, same regulatory outcome. Third, technology-independent objectives, but technology-specific tools. So how should those be affected? Let's look at stablecoins first. As Professor Schwarcz indicated, unless they're backed one for one by very low-risk assets, for example, central bank reserves or short-dated sovereign debt, or appropriately over-collateralized, stablecoins won't be completely stable, and the chance of a run on them under stress will be unacceptably high. There are several flavors of stablecoins. Obviously, what matters is whether or not they are explicitly backed. For explicitly backed payment stablecoins, we should require disclosure of, first, the nature, level, and composition of assets backing targeted redemption value. Second, whether there's full or partial backing. And third, whether there is contingent support. And of course, that means perhaps from an official entity. For issuers of payment stablecoins, require prudent resources and reporting standards that are proportional to the quality and risk of the stablecoin's backing. Require issuers to disclose their identities and to be subject to appropriate regulatory oversight. What about other crypto assets? Not only can the prices of unbacked crypto assets fluctuate significantly, as Professor Schwarcz indicated, there is often limited or no built-in recourse for retail holders if they are lost through error or through theft. Consumer and investor protection is critical. 4 key gaps in crypto assets need to be addressed. First, adequate disclosure. Second, suitability safeguards. Third, cryptocurrency issuer soundness. And fourth, digital IDs and know your customer or KYC enforcement. Turning to governance, I think there is one overarching principle. Same issue, same governance outcome. We propose in the brief that we wrote 4 ways to strengthen governance and the underpinnings for trust in the crypto ecosystem. First, develop and adopt shared codes of conduct and best practices for coders, money services businesses, and exchanges. Second, implement high expectations for transparency. Third, promote constructive exchange between the crypto industry and regulators. And last, coordinate globally. In that sense, the briefs that we wrote are complementary. Appropriate regulation and governance are each alone necessary, but not sufficient. That's true for TradFi or traditional finance. We think it also holds for crypto and DeFi or decentralized finance. Let me add 2 additional points. First, there is a growing literature on crypto regulation that many of you are obviously aware of. One proposal advanced by Howell Jackson and Tim Massett would involve self-regulation with an SRO, and they've recently updated that in an op-ed.
You might define SRO.
A self-regulatory organization. This seems like a final step, but regulation without the legal authority. I think the role of self-regulation is to articulate best practices and good behavior. That's why in our context, I think the sequence matters. Industry governance needs to come first, and then regulation. Second, while I like same risk, same regulatory outcome, not just for crypto, but also for other aspects of financial regulation. Unfortunately, our traditional finance regulation is still inadequate and comes up short. So if it doesn't work for TradFi, why should we think it will work for crypto? So perhaps in thinking about crypto regulation, we can also thinking about improving our TradFi regulation as well. In that regard, my friends Kate Judge and Dan Aury would ask 4 questions to evaluate any regulation. First, does it ensure trust in the financial system? Second, is it holistic? Third, is it dynamic? And last, does it balance benefits and costs? That's all we need to evaluate any regulatory proposal, either for crypto and DeFi, as well as for TradFi.
Thank you, Dick. Our next panelist will be Tom Noone of the Federal Reserve. Tom, please.
Thanks, Stephen, very much for inviting me to join this panel and the World Law Congress. It's a great honor, and it's an honor for me in particular to be sitting next to Stephen and sharing a microphone with him, because I've learned so much from reading his articles over the years. He's a champion of the rule of law and of international cooperation, and he not only proposes things like a model law, he actually writes them too. Stephen's also one of the few law professors whose name makes research economists sit up and listen at the Fed, to give you some sense of the appreciation and esteem in which people hold him. Before continuing, I'm required to say that the views I expressed today are my own, not necessarily those of the Federal Reserve Bank of New York, and I definitely don't speak on behalf of the Federal Reserve System. What I hope to do is offer one person's view on the regulation of crypto assets, maybe taking things one step down from Dick Berner's comments. And I'm going to focus my remarks on stablecoins, which I think are the most money-like of crypto assets. My interest in money, of course, comes from working at the Fed, which is the central bank of the United States. For those of you in the room who aren't familiar with the U.S. regulatory landscape, I wanted to tell you that the Fed is not an omnibus financial regulator. In fact, it doesn't even regulate all of the banks in the United States. The Fed shares the regulatory space with a number of other agencies, federal and state banking regulators, federal market regulators like the Securities and Exchange Commission and the Commodity Futures Trading Commission, and consumer protection authorities, including state attorneys general. Now, part of my job at the Fed in the legal group is assessing proposed legislation and agency regulation. Regulatory proposals in the crypto space are abundant and diverse, but in some discrete areas, they are beginning to coalesce around common issues, even if they continue to offer a variety of solutions. Today, I'm going to try to focus on 3 of those issues and maybe mention a few others as well, then conclude with a general observation. I'll try to keep my comments high level and universal in the interest of this forum. So the first topic I wanted to bring up is who should regulate. The Financial Stability Board, I think earlier this week, came out with a set of regulations, a set of recommendations on regulatory authorities, and it all sort of presumes that there is an authority, a single authority that will be prepared, will exercise readiness, legal authority, technical proficiency, and will coordinate with peers overseas. But I think that's very unlikely to be the case in the US just because of the nature of our financial regulatory regime. I also think that the decision on who regulates crypto assets and stablecoins, in particular in the US, is really going to be a political decision. It's going to have to deal with horse trading among committee members, the relative powers of congressional committees, as much as it's going to do with actual technology or market need. The first issue, I think, under the category of who should regulate is the sort of general public policy question of, should it be the markets or should it be government? And I think that, unexplored in a lot of the discussions on regulatory authority in the US is a role for professional market discipline or a self-regulatory organization, especially given the fact that ordinary consumers or customers, as they're coming to be called in the space, aren't going to be in a position to read disclosures and make very well-informed decisions in a retail context. If we go down the route of government, which seems inevitable, should it be Congress or the states, or federal government or the states? And here we have a range of proposals, some of which propose compromises to share jurisdiction between the two sets of sovereigns in the United States. A lot of these compromises, in my view, are ugly. In fact, one of the proposals introduced in Congress by Patrick McHenry, who's the chairman of the House Financial Services Committee, and Maxine Waters, who's the ranking member, was called by McHenry the ugly baby, in part because it tries to split jurisdiction among the federal and state regulators in a way that made no one happy. I think that one of the risks of having a split in jurisdiction and allowing states to license crypto asset issuers or stablecoin issuers is perhaps a proliferation of issuers and a race to the bottom among regulators to try to attract issuers to their jurisdiction. One other issue that bothers me is the extent to which agencies will be entrusted to exercise discretion. They, potentially have the power to grow and restrict markets to an extraordinary degree, and to a degree that I think really should be the responsibility of elected officials in Congress. The final observation I have here is on the perils of joint rulemaking. Even if you were to consolidate authority over stablecoin issuers at the federal level, a lot of proposals call for joint rulemaking among the federal agencies, and just my own experience with this is it's much more easily said than done. Second topic I think is on everyone's mind is the topic of reserves and stabilization mechanisms. There's general consensus that reserves need to be high-quality assets for stablecoins. There needs to be a degree of transparency and some kind of audit mechanism, invoking the Russian expression "trust but verify." And the key question is, how do you know that the pegging or stabilizing mechanism works reliably? Should there be some kind of test period built into regulation? One question I have in this area is, are we better off starting with collateral that's actual cash, 100% backed by fiat currency? Does that make stablecoins kind of a tokenized deposit? Should there be personal liability for managers and directors responsible for the issuers? What kind of buffer on reserves do you want to have to mitigate the risk of runs? And that brings me to the third main topic I wanted to mention, redemption. And here, my concern is principally run risk. The recent runs on Silicon Valley Bank, Signature Bank, and First Republic illustrated how speed of runs is increasing and contagion is sometimes uncontrollable. And this is especially true in the case of First Republic, I think, which didn't have an asset balance sheet full of problem assets, but was just sort of caught up in the media buzz around Silicon Valley Bank and Signature. What I think issuers of stablecoins make their money through fees and short-term investments on their reserves. Any legislation or regulation is going to have to govern the convertibility in the way that guarantees or lessens the risk of run and prevents systemic instability. Some questions that come up here are whether issuers should have discount window or other emergency lending access from the Federal Reserve, and with what collateral. I'm also curious on whether a regulatory regime should mandate insurance or some kind of mutual insurance coverage among issuers. Those are the three principal issues I wanted to mention. Other topics that come up are regulation beyond issuers, of exchanges, of brokers, of service providers to issuers, consumer protection, which Stephen mentioned. In fact, the revised Lummis-Gillibrand bill, which regulates not only stablecoins but a broader class of crypto assets, has proposed a new agency to regulate consumer protection. I think an interesting issue is whether enforcement of private rights should be left to public authorities or whether there should be a private mechanism too. A big question on my mind is who pays for new regulation and supervision? Should it be the issuer, the customer, the taxpayer? I'd caution all of you not to underestimate the cost of this. Financial inclusiveness arguments, I think, are also important and run into concerns about anti-money laundering, anti-terrorist financing, and sanctions compliance. And finally, financial stability concerns. Foremost in my mind is whether the technologies we have are good enough to be deployed broadly and reliably. The Federal Reserve Bank of Boston issued a report 2 years ago on retail stablecoins and central bank digital currencies, in which it found that the blockchain technology causes insuperable bottlenecks at the retail point of sale state. So those are just some of the issues I'm considering. My final concluding thought is about why we trust banks and other financial institutions to hold deposits, make payments, and return our deposits on demand. There's a combination here, I think, of good regulation and supervision, a trust in the rule of law, and that's our court system. But beyond all of that, I think it's really social convention. And I'm not sure when our social conventions will extend the same level of trust to stablecoins and other crypto assets as they do to fiat currencies. Thanks very much.
Thank you, Tom. Our next speaker will be Andrea Oviedo from Bolivia.
Thank you for this panel.
Thank you. You may want to project because there's some background noise and I want to be sure everyone can hear.
Okay. So actually, I'm not from the legal branch. I work as a financial advisor. So my point of view is like more of the retail point of view, and it's because digital assets are trending towards becoming a part of mainstream portfolios, as my clients always request for it, and so we have to learn a little bit about. I really believe the regulation is really necessary to protect the client. I'm more from the client point of view, as crypto has already been legitimized in the mind of many, especially the younger ones. They really think the crypto is not only money substitute, but it's a money improvement. But what we see is institutions, entities, commodities, and assets that masquerade as something different, but in reality, they are exactly what we have seen before. These are institutions that are bank-like, that offer bank-like services. These are exchanges that offer securities, which they call token and coins, but they do the same thing that we've seen before. And so I believe, I don't know which regulator, but I don't believe they have to create more new regulator system. They have to use the existing authorities as they've been trying to get better with the years. I think that in the failure to do so, to allow people to present bank-like instruments or bank-like institutions to sell securities under the name of token is really to invite to lawlessness. As for stablecoins, I think they really should be forced to have bank charters, and they should be regulated as banks, because in my point of view, that's what they're doing. It's like they're giving checking accounts, they are allowing to transfer. It's just the different technology for the exact same thing that we'll be doing for years. And even though they don't want to regulate it as banks, they at least should be regulated as money market mutual funds, because they really look like them. But we work mostly in the regulated financial system, but mostly in my region, we really acknowledge the benefits of the cryptocurrency system, because the cost of transferring money across national jurisdiction is in some cases prohibited, mostly in regions like mine, where all the monetary policies have a lot to do with the political. So, for instance, in my country right now, for transferring money abroad, you have to pay 10% because we don't have any currencies. So cryptocurrencies are becoming a solution. Well, I want to focus a little bit in the FTX fraud, as is what most harmful for my clients because it had a lot of publicity, and a lot of people who were in the traditional system migrate to FTX. And what I've heard a lot is that as younger people are in this system, they're going to learn from their mistake and they don't need to be regulated. But I don't think that the instant of a scandal and crisis and the crypto winter is a sufficient discipline for the markets, especially in the medium and long term, because after 3 years, they forgot what they have lost 3 years ago and they'll start over. The FTT token issued by FTX and collateralized and used as a basis for loan and from other institutions, it was a security. And yet, the SEC did not shut it down. And I don't think it was because they don't know about it or because they didn't want to. It's because the existing regulatory authority is so ambiguous, and we have to fill those gaps of ambiguity. Then, in the crypto, what this reflect also was the difference that exists in the regulatory system in different countries. For example, in Japan, they didn't allow this company to be fraudulent with their citizens, but in the US, FTX, who was implanted in Chicago, or global FTX, who was implanted in the Bahamas, didn't have protection for the clients. As in my region, in Latin America, we admit that digital assets are really inclusion for the region, because more of 50% of the region is not in the traditional banking system. So it's really popular down there, but the states are starting to be afraid of, and from Mexico to Argentina, they started to regulate it, but it's so unknown that we have things very controversial. As for instance, in my country, it's outright prohibited. You cannot issue, it's penalized by law, but in El Salvador, Bitcoin have become the current currency. So therefore, there's a lot of gaps to be filled in a global kind of way. And I have a question for you, as more like the client point of view, because we have a lot of clients investing in cryptocurrencies with issuers that are regulated in Bahamas and another offshore jurisdiction, and how we do with the gains, how the tax regulation for the client who is recording gains is going to do in the countries. If you are an American citizen, but you are gaining money on cryptocurrency, how is the tax regulating, and how we are going to make our tax planning if we don't know if we have to be declaring in the country of the issuer. Is the main problem for our clients in the wealth management industry that had made a lot of money and have lost money in this kind of assets is the tax part.
Okay. Thank you. We will discuss that during the Q&A. Mm-hmm. Thank you for raising that. Our next speaker will be Douglas Arner from the University of Hong Kong, and he will discuss stablecoins versus CBDCs versus other cryptocurrencies. Douglas.
Thanks, Stephen. And a big thanks to Stephen for the invitation to be here, and to the World Jurist Association for the event. First time back to New York since COVID, and really good to see a positive sort of atmosphere in the city. So really, really nice to be back. As Stephen said, what I want to highlight, and I want to talk about this sort of big picture where I see some of the most interesting emerging trends in crypto versus stablecoins versus CBDCs. And I'm basically not going to talk about the US at all. I'm going to talk about the non-US context. And so if we think about this idea of crypto, basically the idea of privately issued digital tokens, beginning with the Bitcoin white paper in 2008, first blockchain launched in 2009. And I think as Andrea has highlighted in particular, we've now seen a number of cycles, which are pretty common from the standpoint of the evolution, as Richard was highlighting, of financial products over time. And I think what we're starting to see in the jurisdictions that are allowing this to move forward is a sort of common approach. The first, really lots of effort on the market integrity side, basically money laundering through the Financial Action Task Force. There's been a lot of efforts here. From the standpoint of actual law enforcement has developed a high level of comfort with cryptocurrencies. Why? Because it presents a handy record and a graphic representation of network interlinkages to other criminal connections. And this is something that from the standpoint of law enforcement, there's actually now almost a preference for criminals to use crypto. From the standpoint of AML, as I said, a lot of effort here. Post-FTX, I think this is where we're seeing the emergence of licensing, and in particular, real care around the terminology exchange. The term exchange is a loaded term in much the same way that the term bank is a loaded term. And I think we're seeing an increasing trend towards legally reflecting this and offering a different series of licenses for different functions in the crypto space. Enforcement has become very active. Court decisions are increasingly common on a range of particularly private law topics as a result of a number of large insolvencies. And we're seeing, particularly as a result of those insolvencies, real valuation, which is beginning to crystallize into disclosure approaches. So I think from the crypto side, we're beginning to see, particularly across the UK, EU, Japan, Singapore, Hong Kong, Switzerland, a sort of common approach. From the standpoint of stablecoins, it's interesting because stablecoins emerged 2013, 2014 with Tether as a mechanism largely to bridge crypto and traditional finance. But they really moved to an entirely different level with a proposal by Facebook in 2019 to create their own digital currency called Libra. And of course, the reality with Libra was it presented a real threat of currency competition, not only to developing country currencies, but to major country currencies globally. And as a result, we see a two-track approach from countries beginning in 2019. One is through the G20 and the FSB to develop a series of common agreed principles, as Thomas was mentioning, for global stablecoins. And outside of the United States, we're now seeing these crystallizing into regulatory frameworks. The EU is done, the UK is done, Japan is done, Hong Kong, Singapore, final consultations. What this is likely to mean is that sometime in about the next 12 months, one is going to be able to get a license in one or more major jurisdictions to issue stablecoins. And as I think Tom highlighted very well, we're seeing a number of different approaches. Some are basically e-money approaches. E-money approaches date back to the 1990s. Basically, this is one-to-one fiat currency backing for the stablecoin. The problem with this, and legally we can do an e-money stablecoin in many jurisdictions right now, it's just commercially it's not very attractive from the standpoint of the issuers. The second is, I think, as Andrea was highlighting in particular, but also Tom, the idea of bank models. And this is something that if we look at older monetary models in the context of, say, the gold standard, or in the Hong Kong context, where we actually have a currency board, this sort of bank-based model is something that's very familiar. And this, I think, is one of our biggest implications, is we have quite a few large banks around the world who have spent a very large amount of time and money developing their own blockchain-based platforms. And from the standpoint of a bank license model, the most attractive route is for a licensed bank. If you are a major licensed bank in a major jurisdiction, you already have a banking license, and as a result, getting a banking license to issue stablecoins is not that big of a step. Now, for your non-bank issuers, your alternative issuers of stablecoins, that's likely to be a big step. But I think this is one of the most interesting things, is what we're likely to see, in my view, in the next year, is a number of major banks in major currencies in major jurisdictions issuing stablecoins, which they are then embedding in a variety of transactions, particularly wholesale transactions in the debt capital markets context. Final structure, which you're seeing as well, is the money market mutual fund structure. And this is the most common model of existing stablecoins in the markets, largely because of the way the transaction is structured and the benefit it offers to the stablecoin issuer. In other words, in a traditional money market fund, you as the investor will get the return on those assets. In a traditional stablecoin structure today, which may be done like a money market mutual fund, the issuer of the stablecoin keeps the return on those assets. And that's something that I'm curious to see as we see potentially traditional financial institutions enter, whether that will change. Last point is really around central bank digital currencies. And I mentioned post-Libra, one approach was towards the G20 FSB discussions. The other was to central banks looking at their own systems, particularly in the context of central bank digital currencies. And probably the highest profile example was China's announcement in September of 2019 of its intention to move what was then called the Digital Currency Electronic Payment System, now generally called the ECNY, to live trials in 2020. Those trials are still ongoing, but we now have a number of jurisdictions led by the Bahamas and arguably Cambodia, plus Nigeria and a few others, which have now actually issued central bank digital currencies. Most recent survey from the Bank for International Settlements suggests that approximately 100 central banks around the world are working on related projects, with an estimate that in the neighborhood of 20 to 30 may have live currencies by 2030. Now, from the standpoint of central banks, these raise all sorts of interesting issues, particularly around legal authority to issue these assets, and the various sorts of structural considerations, as well as from the standpoint of impact on the banking system. But from my standpoint, I actually think the most interesting issue is from the standpoint of your point about cross-border use. And we are seeing some very interesting recent proposals from the IMF and the BIS in particular about how one might be able to build a new structure for cross-border monetary arrangements as well as payments. And I think from the standpoint of interesting issues going forward, that is probably the most significant. Thanks, Stephen.
Thank you. Our last panelist is Dasong Yuan, professor at Beijing Normal University Law School, who will propose inclusive rules for the regulation and governance of digital economy worldwide. Please.
Okay, thank you. Thank Professor Schwarcz. It's an honor to say something on the digital economic, also as well as the crypto economic, and so on. In China, this topic about the bitcoins, crypto coins, and something is compressed.
Could everyone hear? Okay.
It's compressed. Yes, China is big. One country, two systems, and 4 jurisdictions. So in China, the mainland China law and policy on crypto are changing, always changing. Until now, in the mainland China, it's illegal to issue tokens or mine diggings and making exchange for bitcoins and so on. It's all illegal in the mainland. But in Hong Kong or Macau or even Taiwan, it's another 3 jurisdictions. Especially in Hong Kong, recently, the Hong Kong government is fighting with the Singapore government to make Hong Kong as the Web 3.0, right? Asset concentration center in Hong Kong as another kind of new financial center. So Hong Kong is fighting hard for this field, I think. And very funny, recently we know that a case in maybe America versus a man called Zhao Changpeng, right? Because this man holds the maybe most richest in China, according to the value of the bitcoins he holds. So it's a very funny case. As these activities, these coins are securities or assets, should be governed or regulated by the SEC in the United States, or it's only freedom economic behavior. The case is not close now, I think. We all looking focus on this case because there are some issues on if this world, or especially the American government will make tough, strict policy on this field, or make it free, more free. You see this case. Okay, and last, I want to say something about myself. I'm a law professor in Beijing University, Normal University. I am the initiator of rule of inclusive rule of law and world economy law. First one initiated in China, and I recently published an article in the People's Forum in China, very famous journal, on the inclusive digital economic rules and regulations. In my opinion, just like the traffic rules, it's worldwide, or even the trade, world trade, WTO, we know that. But why we cannot build to proposing a worldwide inclusive digital rule of law? That's my suggestion. Okay, thank you.
Thank
Ben.
you. Okay, I'm going to open to the floor for questions, and also at some point we should answer Andrea's question. Let me ask. Anyone? Okay, so Andrea's question was, if you invest in a cryptocurrency, and basically the value of the currency goes up, what are the tax ramifications? Have I articulated that correctly?
Once you take your gain and you want to declare it in your jurisdiction, how do you declare it, how you pay that? The tax planning for it remains really unclear for the consumer.
Okay, so I'm not a tax lawyer. I know a bit about tax. Is anyone here a specialist in tax?
No, but my tax professor in law school was Sam Bankman-Fried's father.
Oh, okay.
Reportedly, he's a good lawyer.
There you go. So the answer is that you don't declare it at any cost. You just okay. I mean, I assume, this gets in a number of issues. A related issue is to whether the investment in the cryptocurrency is an investment in a security. You have those two things, and that's not been quite resolved. To the extent you buy cryptocurrencies and you intend to use it as a currency, I think everyone would agree that's not a security, and that if the value goes up, that shouldn't be taxable. I mean, so if I purchase some foreign currency and keep it in my wallet, I'm going to use it to buy something. But to the extent the currency would be viewed as a security, then, an increase in the value of security, I presume it would be taxed. And in terms of who would tax it, as I tell my students, every government taxing authority that has some connection would like to tax it. So, you have, of course, the jurisdiction, the investors jurisdiction would like to tax it and would have jurisdiction over the investor. There could be other jurisdictions that would like to tax it. This is apropos of the idea, what's it called, where you have, for example, a foreign withholding tax. So, for example, let's assume that I am making a loan. See if I can get this right. I'm making a loan, and the borrower basically pays interest on the loan, and that interest would be taxable in the jurisdiction of the lender. But could the borrower's jurisdiction also tax the lender on the theory that the lender has made a profit but is not subject to the jurisdiction of the foreign country? And some foreign countries impose the withholding tax, where they basically require the borrower to withhold repayments to the lender in amounts that would be taxable. Okay.
But there's a lot of agreements to avoid the double taxation.
Yeah, you have these bilateral tax treaties. That's correct.
For cryptocurrency, there isn't, and especially in our sector where we make money by doing tax planning for our clients, it's really difficult with cryptos. We cannot. So that's why I was raising the questions.
Yeah.
Let me just add a couple of points on that, actually. I think the first is that increasingly we're not seeing issues in terms of valuation. In other words, we've got the insolvencies, and the insolvency administrators are quite happy to value. You've got divorce quite happy to value. Estates, when you've got a death in an estate, quite happy to value. So we're getting crystallization around valuation. And I think this is important, but I think your points about tax are really invalid. One, though, is we're seeing more and more countries which are basically saying existing tax system applies to crypto. Now, yes, it can be a challenge to catch it. But basically what tax systems tend to look for is those crystallization points. It goes into a bank account, there's a transfer, there's a death, there's an insolvency, there's a divorce, etc. So you get these points, but there isn't a good sort of all the time system. Where we are seeing some interesting discussions is in a number of jurisdictions which are talking about basically real ID wallets. India is an example where they're talking about basically a sort of crypto CBDC wallet, which is then linked to a biometric ID. That would then deal with both your AML market integrity issues, but also deal with India's capital controls and tax issues. Similarly, if we look in the EU, discussions in the context of basically linking their existing sovereign ID regulation to sort of crypto stablecoin CBDC wallets, which would then deal with the same sorts of aspects. So I think not necessarily a simple solution, but we are seeing an increasing focus both from the standpoint of actual valuation, extension of existing tax rules to try to catch, and from the standpoint of trying to think about ways where you could actually sort of jurisdictionally trap transactions.
Stephen, can I ask a question?
Please.
Of the
Absolutely.
three lawyers on the panel, I'm not one. And that is, you referred to the idea that this is related to whether or not an asset is a security or not. But it seems to me that there are plenty of assets on which capital gains are realized and which are subject to tax in one way or another, or to exemption from tax. So I'm not sure that, certainly there are some security aspects to this, but it seems to me that this issue is a broader issue and doesn't depend on whether the crypto asset is a security or something else. Second issue is, and it seems to me this cuts across Andrea's point, that if you don't have cross-border agreements on tax, that is an impediment to cross-border transactions, because then her clients are going to be uncertain about what the tax implications of any transactions that they might make on a cross-border basis involving these assets. And the last point I would raise, which is sort of related to my original points, is we can solve a lot of the problems that we're talking about here that crypto enthusiasts claim that they have solutions for without using crypto. So cross-border payments is something that we've struggled with for maybe millennia. But you know, today we have the technology, and all we need is the political will and the governance to achieve a more efficient, effective cross-border payment system. It doesn't require either CBDCs or crypto assets. What it does require is coordination across borders, that authorities and that institutions can get together and agree upon on how to do it.
Yeah. And let me quickly respond and then ask others to correct me, because I'm sure I'll be giving misleading answers to your good questions, Dick. The reason I raised the issue of security for two reasons. One, to say that another regulatory issue is not just tax, but whether it should be regulated as securities. But the other reason is, I mean, you're right. If I invest in some asset and it gains value, I could have a capital gains tax, except that to the extent that crypto is regarded as a currency that is intended to be used for payment and not for investment, I don't think that that regulators will tax increases in values of currencies. I'm not aware of it.
Isn't it true that you know, people who transact in cryptocurrencies are quite concerned about the tax implications of any gains that they might realize on the transactions in those currencies?
Yes, but that's
exactly right. Sorry,
Yeah.
That's 100% accurate. I'm not a tax lawyer, full disclosure. But personally, professionally, very involved in cryptocurrency. And the biggest concern is, putting aside the lack of clarity, is that if you own a specific currency and you converted to a different coin, that's a taxable event. And what happens with crypto enthusiasts, people who are very actively involved, it's you do that 10 times in one day, that's 10 taxable events.
Wow.
And then how do you report that? The big problem is accounts. A lot of them aren't necessarily fluent in how to even read the ledgers that you get from OpenSea or Kraken or Gemini or whatever it is. And it's a big source of contention in the community. I didn't mean to jump in.
No, thank you.
That supports,
That's great.
that supports my understanding, and I think that's not just a cross-border issue, that's a big issue domestically as well.
Yeah, and on the domestic front, the Lummis-Gillibrand bill that was just revised last month, I think exempts certain transactions from capital gains treatments of like transactions under $200 or something. And the idea is to allow cryptocurrencies to be more currency-like, less securities-like. So even if they are treated as a security, small denomination transactions are exempt from capital gains treatment. And then the other issue that legislation tries to tackle is reporting to the IRS by the financial sector intermediaries, existing banks and the new ones, so the IRS knows what's happening.
Yeah, and that whole issue raises questions, of course, about decentralized finance, DeFi, where you don't necessarily have clear intermediaries, but that's beyond the scope of this. Dick, you had another question, I'm not sure, or maybe did we answer effectively both of your questions?
Well, the broader one, which I think is the most important one, is there's a presumption in this discussion that cryptocurrencies have some benefit and that and crypto activity will solve some of the problems that we have in traditional finance. I am far from convinced of that. I haven't seen any evidence of that. And so the question is, when we think, and that's one of the reasons that I emphasize governance, because it seems to me that in order to have a financial system that encourages trust and that engenders trust, there has to be good governance and good behavior among the people who are transacting in it, who are issuing it, who are the participants in that activity. And we have that in TradFi in a variety of ways. Obviously, there's going to be deviation from that. There are going to be always bad actors who seek to exploit the loopholes and who engage in illicit or criminal activity. But the fact of the matter is, we have agreement on a lot of things in our financial system that make it work well, that make markets fair and effective, that make people that engender trust in our system. We do not have that in crypto. Indeed, it seems to me that crypto, among many people, is a rejection of that ecosystem, and then says, trust in the code. Well, on-chain governance, to me, is not something that people can trust, because when it goes wrong, when there are problems with it, when there are cyber hacks of the code, when there are fat finger errors or errors in the code, and when people can use the code and manipulate it to steal from others, which is prevalent in the crypto world. It seems to me that the crypto world needs to get its act together and say, this is something that you can trust rather than something that's going to be beneficial to us, the issuer, at your expense.
Yeah, as you can see, Dick is a real proponent of crypto. But let me just add first to that. I agree with what you're saying, and I agree that there's actually a question as to whether crypto is needed. To the extent, for example, that you have central bank digital currencies being considered, they're really to try to, at least in part, to protect against the private sector competition. But I propose, and Tom and I've talked about this, and with others, you actually could have an electronic funds transfer system today without, at least in the U.S., without doing anything, because you already have wholesale electronic funds transfers. you have a body of law, the Article 4A of the Uniform Commercial Code, that governs that, and you could apply the electronic consumer protection laws to that. And, you can do that in a way that I think reduces transaction costs by simply requiring the consumers to have a bank account. It doesn't need to be a bank account with a central bank. It could be any commercial bank account. I mean, the wholesale money transfers now work off of commercial bank accounts. So you could do that. And I think, frankly, central banks ought to be doing that as opposed to creating another cryptocurrency, because cryptocurrencies, as you say, have their own risks.
And as we've seen around the world, there are payments mechanisms that work just fine for actual payment, which is one of the things we're concerned about. PIX in Brazil, M-Pesa in Kenya and other places, that's empowered and created financial inclusion for millions of people who didn't have it before. They aren't based on cryptocurrency or any of those things. Moreover, Tom's organization is about to launch FedNow, which is a faster, cheaper, supposedly payment system that's going to solve some of the problems that we have in our payments systems today, and that will not entail a lot of the risks that we've been talking about here. And what we haven't talked about in terms of risk is the fact that in periods of stress, if you have a central bank digital currency to which individuals have access and for which they have accounts, where are you going to put your money in a period of stress? In the banking system or at the central bank? I'm going to go to the central bank, which is going to disintermediate the financial system at large, which I think is a real problem for any design of central bank digital currencies.
Andrea,
yes,
yeah.
I have to kind of disagree. I really agree with regulation, but in some regions like South America or Africa, cryptocurrencies are coming to fill gaps that government are not performing, because there's a lot of persons that don't even have IDs. So they cannot have bank accounts, and this is a rapid solution for even money that's entering the countries from migration that went working as illegals in other countries are sending money to their families, and mostly there's people that it is abandoned by the government. They don't get to have to be in the system. Cryptocurrency is filling that gap, and so it has to be permitted, but some kind of regulated for avoid money laundering and some of it. But I think it is an improvement that is giving solution to many people who is forgotten in the system.
Yeah, and one of the great benefits of cryptocurrency would be to expand financial inclusiveness to the unbanked. For example, those who don't have ID, those who live in areas that are remote and can't get to banks. So that is a positive. That's probably less of a concern in the U.S. than in other countries, but still, it's even somewhat of a concern in the U.S. Questions?
I was just going to throw 2 points
Please.
out on that. The first is Fred and I have actually written a piece where we look at the evolution of crypto and the fact that you've seen exactly the same sorts of financial misbehaviors and risks evolve over the past 15 years that you've seen in traditional finance over a period of centuries. And as a result, our approach is to argue that largely, as you've said, we have mechanisms that have been developed to deal with exactly these sorts of problems. We should apply them. The irony, of course, is that the genesis of Bitcoin was meant to be a solution to these sorts of problems. And so that's sort of the irony, is that you have a system that is meant to eliminate this sort of misbehavior, but as soon as you add in, actually I think it's the people, that are involved in the transactions, you get exactly the same sorts of behavioral processes we see in traditional finance. And on the cross-border point, I very much agree with you. I think in some ways the most important aspect of Libra was to show that we have technology to build better cross-border payment systems if we want to.
Right.
And so seeing the sort of G20 cross-border payments project that's going on, a range of other projects, and of course, then you see, say, the internationalization of UPI, you see some of the cross-border linkages in the context of fast payment systems and others. I think in many cases, it's likely that these will end up being more significant than the sort of central bank digital currency arrangements. But if what it takes is central bank digital currencies to get some enthusiasm, to get some work done on the rest, I'll take it.
I see the most compelling use case for cryptocurrencies, I think, is in remittances to emerging markets, and financial inclusion in those areas. Surprising, though, that there's a big divide between the G7 on the one hand and the G20 on the other hand. The G7 sort of more crypto agnostic. The G20 is very concerned about the impact that cryptocurrencies used in their jurisdictions will have on the transmission of monetary policy by their central banks. And so they're, I think, understandably quite cautious about moving ahead in those regions.
Mm-hmm. The other aspect that is global in scope is, of course, unique role of the dollar in our international payment system. And I think that in part, in some parts of the world, there's been a long-standing desire to move to a multipolar as opposed to a unipolar currency arrangement, where the dollar is not the reserve currency of the world, and all that implies for power, economic hegemony, if you want to put it in those terms. So I think that's part of the impetus for some of these things, but again, there are other ways to solve that besides adoption of a central bank digital currency system or a digital currency environment.
Don't default on the debt.
I will say one area where I think we are seeing some interesting real pickup in the context of transactions is embedding either CBDCs or, in some cases, stablecoins in the context particularly of debt capital markets transactions, basically atomic settlement for payments. And we've seen major transactions with the Bank de France, with the European Investment Bank, with the World Bank, with the Hong Kong Monetary Authority. Most recently, a really interesting one with Bank of China, where part of it was actually done on Ethereum. And the ability to essentially embed settlement of payment into the transaction is something where I think there is some significant potential uses. Gets really interesting, the sort of question, wholesale CBDC versus, say, private stablecoin in terms of which is better, but I'm quite happy with competition to see how it works out.
Yeah, I mean, one of the things that we need to distinguish between is cryptocurrencies and tokenized financial transactions. Because tokens can be very useful as part of a technological solution to the payments clearing and settlement mechanism. But one of the things that's really important, and we've had discussions at the CFTC and elsewhere about this, is there have been proposals to go to a non-intermediated settlement system. And part of the problem with that is that if the technology functions error-free, that's fine. But technology is rife with the possibility of error, and you want to make sure that you've got a kill switch of safeguards built into the technology so that if errors are made and somebody types in 2.5 million instead of 25,000, that there is recourse for correcting those errors. And where we've got financial institutions, the largest of which in this country does $6 trillion of transactions on a daily basis. Where in The foreign exchange market, we see $5 or $6 trillion of transactions on a daily basis. The technology, generally speaking, works fine, and kill switches and error correcting mechanisms are built into those transaction systems. If we take those away, then I think we're in for a lot of problems.
Yeah, just one last word. Of course, Article 4A of the UCC does at least purport to cover issues of mistake and of that sort. And so that, I think, is probably worth some study. The other thing is that, well, if you get to technology that includes smart contracts are simply computerized algorithms. When you put stuff in, you get answers out. A lot of the people back in the crypto market are sort of touting these smart contracts, but you have the old risk computers of garbage in, garbage out, and a lot of work needs to be given, or a lot of thought needs to be given as to how do we correct smart contract mistakes, either bad programming or bad input, which goes to your point.
Right.
Any final question before we close the session? Yes.
I have a question about the recent Ripple case and how it might possibly affect the Howey test application going forward. So the way I understand the Howey test, there's 4 elements: an investment of money, a common enterprise, with reasonable expectation of profit based on the effort of others. Now that there's all this innovation and all this generative AI technology going on, does that defeat that last element, the it's up on the efforts of others? Does it alter it in any way? Is it possible for something to be a security at one point in time and then not become a security later on? That's just the questions I have.
Yeah. Anybody want to try to answer that?
I'll leave it to the lawyers.
You can have this one, Stephen. I'll happily jump in, but you're welcome.
No. I mean, I'd go for it. I just got back from Iceland, so I haven't even read this stuff.
It's a really interesting decision, and of course it was one that's been watched really closely. I don't think this is the end. I think that this one's going to go, so it's probably a little premature to sort of focus entirely on this one. And the decision itself has some issues in terms of how it's written, in terms of clarity, et cetera. So I think this one, we still have a raise to go on it.
As a Noone lawyer, it just seemed to me they got it exactly backwards in the Ripple case.
Yeah.
That it did exactly what you don't want to see happen. But again, I'm not a lawyer.
Okay. Thank you so much.